Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, we're going to be going over how to utilize market structure to anticipate reversals. So in terms of market structure, what I'm talking about is the general application of what we it's everything that we utilize in the Day Trading Academy. The overall structure, what someone jokingly called Brink structure, which I kind of get a kick out of with my last name, but we've got the L5 rotation off of the lows. We've got continuation up to an L3. These are the types of things that I'm talking about when I'm talking about structure. So when I'm looking at market structure, how can we use it to anticipate reversals? We're usually using market structure for a continuation style of trading. But there are ways that we can utilize it in terms of reversals as well. And one of the easiest ways is to utilize disappointment. Let that sink in for a second. I know that sounds weird, but what we're looking for here is something to happen that shouldn't have happened, a disappointing result. As an example, with this big rally off of the lows, we have an L5. After an L5, the typical anticipation would be an L2, and if we roll higher, we have an L1, like, oh, okay, awesome. Maybe the bulls are taking over. But when it came back to the L2, they failed to make a new high. You'll notice right inside here. We got back to the L2. It did bounce beautifully, but not enough to make a new high until it rolled down and tagged into an L3. Now, as far as the L3, that wasn't supposed to happen. It doesn't mean the bull trend is done, but what it does mean is that after the market figures out where its next high is, that could potentially be a reversal point to drive the market down, or potentially where the market gets stuck for the next very long period of time. In this case, I'm looking at a 250 tick chart, so long is relative, of course. Now, if we continue along with this cycle, the market did re-up along with the overall move, right? It did finally continue back up to another high, and that cycle was off of an L3, right down here. Now, after an L3, you would typically assume that the next pullback would be an L1, and, well, we have that pullback. We have the L1 buyers who are trying to get it going, and once again, we have a lower high. So the market, once again, falls short, and it doesn't mean that the market can't go back up to the highs again, but what it does mean is that when the market does figure out where the high is, after it does make it to a new high, it's probably going to go sideways or correct back a little bit further. And this time, it corrected back quite a bit further in that it broke below a previous swing. So that's what I mean by utilizing this for disappointment. Now here's another one. We have an L3 with a continuation to the upside. L3s, you usually want to see an L1 for continuation. And when the market came into the L1, originally they were trying to get that rotation. I say rotation. Nobody even showed up to the beginning of the L1. And it really didn't happen to have any bouncing until they finally got L2, which is a disappointing response. That's not what the bulls wanted. After an L3, the bulls want a strong breakout and an L1 continuation. That's how you get the best reversals that are possible. So the fact that it went to the L2 doesn't mean that the bulls have totally given up, obviously. But when the market does make it back to the highs after that disappointing return, well, you usually anticipate the market to go sideways or correct a lot more aggressively than you anticipate it to. It's a really, really easy way as long as you understand the overall structures. And if you're not familiar with it or you have no idea what I'm talking about, you can find out all about this in the Day Trading Academy. It's in chapter Unit 2, Chapter 8. There we go. That covers all that we're talking about here. And the overall concept and the idea and how it all works. It's relatively simple, but again, you can use it for not just trend continuation. That is what it's really good at. But you can also utilize it to show you when the market's disappointed. And, well, when there's disappointment, you expect a little bit less the next time around. Hopefully you find that useful, interesting, entertaining, and of course, if you have any questions, you can drop those in the comments below, or if you have a more detailed question that needs more answering, you can shoot me an email, jhb@ssftg.com. Until the next one, enjoy, rest up, and we'll see you all then. Thanks.